Welcome to this custom-tailored deep dive. We are really thrilled to have you with us today.
Absolutely.
And our mission for this session is ambitious, but we think it's absolutely critical if you are tracking the markets right now.
Highly critical.
Yeah. We are unpacking a massive stack of 2026 financial reports, sector analyses, and macroeconomic data.
Right. The goal is to give you a comprehensive institutional-grade outlook on the U.S. airline industry.
Exactly. Specifically looking at that 2026 to 2027 window, because we are talking about sheer volume here.
Billions upon billions of dollars.
Just moving through the skies at this exact moment, and we are going to focus our lens on the big four.
Right. Delta, United, Southwest, and American.
Because the sheer scale of the top-line revenues these carriers are posting right now, it's honestly something we just haven't seen in the history of commercial aviation.
It is a remarkable environment, but we need to be incredibly careful here.
How so?
Well, we can't get blinded by those top-line numbers.
Right. The revenue is record-breaking, but
the real narrative, the one that actually dictates valuations for institutional investors and, well, anyone managing a portfolio right now.
it's hidden.
Exactly. It lies hidden in the margins, in the balance sheets, and in some rapidly shifting consumer behaviors.
It's a highly complex ecosystem.
Very. I mean, we have legacy carriers acting more like premium lifestyle and credit card brands.
Yeah.
We have domestic giants undergoing existential identity crises.
And massive structural debt loads acting as anchors.
Right. So we really need to evaluate how these specific companies are navigating the broader economic currents before we even touch their individual stock trajectories.
I completely agree. You really can't understand the airlines without understanding the economic air they are flying through.
That's a great way to put it.
So looking at the latest reports from the Treasury Borrowing Advisory Committee and the Stanford Institute for Economic Policy Research.
This SEPR report, yeah.
Right. The U.S. economy is showing a very specific kind of resilience right now.
It is.
We have an estimated fourth quarter 2025 GDP growth sitting at a solid 2.2%.
Which is healthy.
It is. And meanwhile, headline inflation, the CPI, is hovering at 2.7%.
Right.
And the labor market is in this really unique equilibrium. Economists are calling it a low-hire, low-fire environment.
With unemployment sitting right at 4.5%.
Exactly. So what does this specific macro picture mean for the global airline sector?
Well,
Especially when you consider that the International Air Transport Association is projecting a record $41 billion net profit for 2026.
yeah, that $41 billion figure, I mean, it sounds phenomenal on a press release.
Right.
Until you look at the margin.
The margin is tight.
Incredibly tight. IATA projects that net margin to be a remarkably tight 3.9%.
3.9% on record revenues.
Exactly. And what's crucial to understand here is how the specific macroeconomic backdrop creates a highly targeted challenge.
For capital-intensive industries.
Right, like airlines. You mentioned the 2.2% GDP growth and the 2.7% inflation.
Yeah.
That combination presents a mild stagflation challenge for the Federal Reserve.
Because they're trying to balance cooling prices with that low-hire, low-fire labor market.
Exactly. Companies aren't aggressively hiring, but they also aren't doing mass layoffs.
So people have jobs, but things are expensive.
Right. And for airlines, which are saddled with immense fixed costs,
We're talking airplanes, jet fuel.
unionized labor contracts,
Yeah.
that persistent 2.7% inflation puts relentless upward pressure on their operating costs.
Because unemployment is stable at 4.5%, consumers still want to travel.
They do, but the cost of living anxieties are very real for them.
I have to push back a bit on how sustainable that is, though.
Sure.
If everything costs more to operate, from the ground crew to the catering to the maintenance,
Right.
how do airlines make a 3.9% average margin work without just pricing the average consumer out of the sky entirely?
This is exactly where we see the structural industry shift toward premiumization.
Premiumization.
Yes, because post-pandemic consumers, despite those exact cost of living anxieties we just outlined,
They're still spending.
but they are demonstrating a persistent, almost inelastic willingness to pay disproportionately more for space.
For comfort and service.
Exactly. They might defer buying a new car.
Or upgrading their appliances.
Right. But they're fiercely prioritizing experiences.
So the airlines have realized the real margin expansion isn't in the back of the plane.
No, it's not in trying to pack one more row of economy seats into the cabin. It's in business class.
Premium economy.
Extra legroom. Exclusive lounge
This
access.
is at 3.9% industry average
It masks a severe divergence.
between the haves and the have-nots.
Exactly. Between airlines that have successfully premiumized their cabins and those that are still fighting a race to the bottom on base fares.
And what really stood out to me in the data is that it isn't just the passenger-facing experience that is changing here.
No, the back end is entirely transforming.
Right, the back-end operations are undergoing a quiet technological revolution.
The AI integration.
Yeah. The reports show that 97% of airlines are currently using or actively integrating artificial intelligence into their operations.
97%. It's ubiquitous.
We are talking about predictive maintenance, highly complex crew scheduling algorithms, and dynamic pricing models.
Right.
And this ties perfectly into the broader economy's productivity numbers. In mid-2025, the U.S. economy saw a non-farm productivity surge of 4.1 to 4.9%.
Which the reports heavily attribute to AI adoption.
Exactly.
And if we connect that productivity surge back to the stagflation pressures we just discussed,
It becomes a survival mechanism.
completely. If your labor costs are locked in at higher rates due to new union contracts,
And you are operating in a low-hire environment where you can't just throw more bodies at a problem.
right, the only way to protect your margins is to make your existing workforce and your physical assets exponentially more efficient.
Like with predictive maintenance.
Exactly. Take predictive maintenance. Historically, an airline fixes a part when it breaks.
Which leads to a grounded aircraft.
Canceled flights, millions in lost revenue, and angry passengers needing compensation.
But now, AI models analyze sensor data from the engines in real time,
Predicting a component failure days before it actually happens.
allowing the airline to replace it during scheduled overnight maintenance instead.
And that operational efficiency goes straight to the bottom line.
But looking at the macroeconomic risks, the new tariff environment is a major variable we have to factor in here.
Oh, absolutely.
Goldman Sachs is projecting that current tariff implementations could raise inflation by a full 1% between the second half of 2025 and the first half of 2026.
It's a significant headwind.
And we are simply reporting those economic projections impartially here, just
Yeah.
looking at the math. Plus, we have ongoing Middle East tensions
Right.
and the continued closure of Russian airspace.
Which is forcing significantly longer flight paths for major international routes.
Those are critical, unhedgeable variables.
Totally unhedgeable. Tariffs directly impact the cost of imported aircraft parts,
Specialized metals.
the broader aerospace supply chain.
Yeah.
And the airspace closures are just a massive logistical headache.
Because an airline might have a perfectly optimized domestic strategy.
But if they are highly exposed to Asian routes that now require an extra 2 hours of flight time just to bypass restricted Russian airspace,
They are burning significantly more fuel.
and increasing the wear and tear on the aircraft,
So their cost per available seat mile takes a direct, unmitigated hit.
it is a very fragile ecosystem where external geopolitical events can instantly erode those operating margins.
It really is. Now, before we unpack our first major stock and look at how they are navigating these exact headwinds, if you are finding this level of deep dive financial analysis valuable for your portfolio, make sure to like this video, drop a comment with your top stock pick, and subscribe to the YouTube channel.
It really helps.
It tells the algorithm you want more institutional grade insights, and it helps us keep delivering them directly to you.
Absolutely.
Okay, let's unpack this. We have established the macroeconomic air these carriers are flying through.
Right.
Let's look at the undisputed premium leader of the pack, Delta Airlines.
Ticker symbol DAL.
Exactly. When we look at Delta, we are looking at the world's leading airline by revenue.
By a significant margin.
Their 2025 numbers are exceptional. They posted a record operating revenue of $58.3 billion.
Up 2.3%.
Right. And they pulled in a $5 billion pre-tax profit, maintaining a 10% operating margin.
Which generated $4.6 billion in free cash flow.
$4.6 billion.
Those figures are the benchmark the entire legacy industry is trying to emulate right now.
But what is truly insightful here is not just the aggregate revenue.
No, it's the composition of that revenue.
Right.
Delta has successfully decoupled itself from the traditional, highly cyclical, boom and bust airline business model.
Because 60% of their revenue is now coming from high-margin, diversified streams.
Exactly. We are talking about their premium seating products,
Yeah.
Delta One and Premium Select,
We are talking about their cargo division.
and their maintenance, repair, and overhaul business.
MRO, or Tech Ops.
Right, which actually grew by 25%
Yeah.
because they service third-party clients, not just their own fleet.
But the absolute crown jewel of their diversified revenue stream is their partnership with American Express.
It's staggering.
That co-branded credit card relationship generated $8.2 billion in remuneration in 2025 alone.
I really want to pause on that number
Yeah, please do.
because it is essential for understanding Delta's valuation. $8.2 billion just from a credit card partnership.
It's pure profit, essentially.
That means Delta is basically functioning as a highly lucrative, high-margin loyalty and lifestyle brand.
That simply utilizes a fleet of airplanes as the fulfillment mechanism for that brand.
Exactly. They are a bank that flies planes.
So how is the market valuing this? Right now, the stock is trading around the $61 to $63 mark.
Right.
The price-to-earnings ratio, or PE, is sitting at 9.0x.
A single-digit multiple.
Yeah. Wall Street has a consensus buy rating on Delta with an average price target of $80.38.
Implying an upside of over 30%.
Plus, they recently reinstated a 19-cent quarterly dividend.
Which income investors love.
But I have to ask, if they're generating billions in cash and operating like a premium lifestyle brand, why is their PE multiple stuck at a single-digit 9.0?
It's the classic airline problem.
Because tech companies with worse cash flow trade at 30 or 40 times earnings.
That is the perennial question for airline investors.
Right.
The market historically assigns a cyclical discount to airlines.
Because they are notoriously capital intensive.
And highly vulnerable to external shocks. Pandemics, oil spikes, volcanic ash clouds, you name it.
So the market just doesn't trust the earnings to last.
Exactly. The investment thesis for Delta rests entirely on their ability to prove to Wall Street that their margin leadership is structural, not cyclical.
And they are trying to prove that through the premium traveler.
Right, because they cater to that premium traveler and have such deep brand loyalty.
Which is clearly evidenced by the fact that they acquired over 1 million new Amex cardholders for the 4th consecutive year.
Incredible stat. Because of that, they possess immense pricing power.
So if jet fuel prices suddenly spike by 20%,
Delta can pass those costs onto their premium corporate and leisure customers much more effectively than a discount airline can pass them onto budget travelers.
the budget traveler just stops flying.
Exactly. So the bull case argues that a 9 PE fundamentally undervalues their earnings quality and that massive free cash flow generation.
I see the upside, but let's be realistic about the risks here. Delta isn't immune to the macro environment we just discussed.
Absolutely not. The primary risk is macroeconomic sensitivity. If the U.S. economy slips from that low-hire, low-fire equilibrium into a true recession with mass layoffs,
Corporate travel budgets will instantly tighten.
and that premium leisure spending will take a severe hit.
Furthermore, we have to look at their balance sheet mechanics.
The aging fleet.
Yeah, Delta has aging segments in their fleet, particularly their Boeing 757s and 767s.
Which will require significant capital expenditure or CapEx to replace in the coming years.
Because buying new wide-body jets costs billions.
And that will eventually weigh heavily on that free cash flow number.
Let's contextualize Delta's operational efficiency by comparing them directly to their rivals.
Let's do it.
Delta is widely considered the holder of the reliability crown.
Right.
To put their financial efficiency into perspective using the reports, Delta generates $79 million in net income for every $1 billion in sales.
$79 million.
When you compare that to American Airlines, which generates only $2 million per billion in sales,
The contrast is just stark.
it's night and day. And compared to United, Delta has a significantly superior credit profile.
Having aggressively reduced their adjusted net debt down to $14.3 billion.
That debt reduction is a massive structural advantage.
It lowers their annual interest expense, which means more of their operating profit flows directly to the bottom line.
And it provides them the balance sheet flexibility to aggressively invest in their product and infrastructure.
Right. For instance, Delta recently announced a monumental agreement with Boeing,
To purchase 30 787-10 wide-body aircraft.
with deliveries starting in 2031.
That is a massive capital commitment.
And it is a clear signal of their long-term international growth strategy.
And they're making sure their workforce is aligned with this profitability, too.
Profit sharing.
Yeah, they just paid out a $1.3 billion profit-sharing bonus to their employees.
Which helps maintain that critical operational reliability by keeping labor relations relatively smooth.
Unlike some of their competitors,
Yeah.
they are also continuing to expand their network footprint, launching new nonstop services to Riyadh and Marrakech.
pushing further into high-yield international markets.
So, looking at the scenario analysis for the next 8 months, what moves the needle on this stock?
Well, in our base case scenario, assuming the GDP growth holds steady and Delta utilizes its premium pricing power to offset any rising labor costs.
We target the stock hitting that $77 to $80 range.
Right. In a bull case where perhaps the Federal Reserve executes strategic rate cuts that stimulate corporate spending.
And fuel prices remain stable.
Delta could easily test $90.
But the bear case is very real.
It is. If we see a sudden fuel spike due to geopolitical events or a weakening job market that erodes that crucial premium leisure demand.
The stock could stagnate or drop back to the $62 to $65 support range. Okay, so we have established that Delta holds the reliability crown and the premium profitability crown.
Without a doubt.
But there is another legacy carrier aggressively chasing the growth crown.
And that brings us to United Airlines.
Ticker symbol UAL. United is explicitly positioning itself as the international growth engine of the U.S. market.
They really are.
In 2025, they posted $59.1 billion in revenue, which actually slightly edges out Delta's top line.
It's a massive top-line number.
Their adjusted earnings per share came in at an impressive $10.62.
Right.
But the metric that really demands attention here is their unprecedented free cash flow conversion rate of 130%.
It's a wild metric.
They currently have total liquidity of $15.2 billion, and they've managed to bring their total debt down to $25 billion.
We really need to unpack what a 130% free cash flow conversion rate actually means.
Because it is an incredibly rare metric for a capital-intensive business.
Normally, airlines consume massive amounts of cash just to maintain their existing fleets.
Let alone grow them.
Exactly. So a 130% conversion rate means that for every $1 of accounting net income, United People reports on their income statement.
They are actually generating $1.30 in tangible cash in the bank free cash.
Right.
I think we need to explain the mechanics of that for the listener. How does a company generate more actual cash than they report in net income? It sounds counterintuitive.
It does. It comes down to non-cash expenses, primarily depreciation.
Okay.
Airplanes are multi-million-dollar assets that depreciate over decades.
Right.
On an income statement, depreciation reduces the company's taxable net income, making it look like they made less profit.
But depreciation is just an accounting metric.
Exactly. No actual cash leaves the building when an airplane depreciates.
You already bought the plane.
Right. Add in deferred taxes and other non-cash adjustments, and you get a scenario where the reported net income is actually lower than the actual cash the business is throwing off.
Which signals incredible earnings quality.
It proves their profits aren't just paper accounting maneuvers.
And strategically, generating that much cash provides incredible defensive positioning against any economic downturns.
Allowing United to internally fund their own growth rather than going to the bond market and taking on expensive debt at current interest rates.
With that kind of cash generation, the valuation and investment thesis look very aggressive.
Very.
For 2026, United's EPS guidance is a massive range of $12 to $14 per share.
And based on that, analysts have upgraded their target price to $130.
Which is a huge jump.
The overarching thesis for United is built on their structural leverage to global economic growth.
They are currently the largest U.S. carrier across both the Atlantic and the Pacific.
And because international travel demand is projected by IDA to grow at 5.8%,
United is perfectly positioned to capture a disproportionate share of that high-yield, long-haul traffic.
but, as we noted during the macro breakdown, this global exposure is a double-edged sword.
Right. The geopolitical factors.
Specifically, the closed Russian airspace.
It disproportionately impacts United because of their heavy Asian route network,
They're forced to fly longer, more expensive routes.
burning more fuel and requiring more crew hours.
Furthermore, like all the legacy carriers, they are navigating rising labor costs across their unionized workforce.
If we compare United directly with Delta and the broader sector, we see United shifting from being a pure volume play to focusing heavily on premium international routes.
Right. Currently, United is posting a 5.7% net margin.
Now, that is lower than Delta's 7.9%.
But United is actively closing that gap.
Precisely. And they are closing that gap through a massive fleet upgauging strategy.
Updating.
Yeah, which means they are replacing smaller 50-seat regional jets with larger mainline aircraft like the Boeing 737 MX and Airbus A321neo.
This is a brilliant operational move because it solves two problems at once.
Right. First, it bypasses the regional pilot shortage.
Because you need fewer pilots to fly 150 people on one plane than you do to fly 150 people on 3 separate regional jets.
Makes total sense.
Second, it drastically lowers the per-seat operating cost, which expands that net margin.
In terms of recent developments, United didn't just beat Wall Street's Q4 and full-year EPS expectations.
They are actively investing in the physical infrastructure of their network.
Initiating major airport upgrades right now at their Dulles and Houston hubs.
This is all part of a broader strategy to elevate the brand and compete head-to-head with Delta for the highly lucrative corporate traveler.
But I have to challenge the predictions here. Is an aggressive $130 price target actually achievable for an airline?
It feels steep.
It feels like a massive leap from where they are currently trading.
Well, it requires two things to happen simultaneously.
Okay.
First, international travel demand must hold at that projected 5.8% growth rate.
Allowing United structural leverage to those markets to drive revenue.
Exactly. Second, and more importantly, it requires multiple expansion.
The PE multiple.
Right. We talked earlier about Delta trading at a 9 PE. If United achieves their $12 to $14 EPS guidance, and the market simply agrees to assign them an 8 or 9 multiple.
Which is still very conservative compared to the broader S&P 500.
Exactly. The math naturally pushes the stock price toward that $120 to $130 range.
So it's not about United suddenly becoming a tech stock.
It's about the market rewarding them with a slightly less punishing valuation multiple because of their proven free cash flow.
Here's where it gets really interesting.
The domestic side.
Yeah, we have looked at the two legacy premium giants who have clearly figured out their post-pandemic identities and are reaping the rewards.
Right.
Now let's pivot to a domestic carrier undergoing a radical existential identity shift.
Southwest Airlines.
Ticker symbol LUV. Southwest 2025 revenue was $28.1 billion.
Their Q4 net income was $323 million.
They ended the year with $3.2 billion in cash and very low leverage at 2.4 times.
On paper, those metrics look relatively stable.
But underneath the hood, the entire business model is being rewritten.
It truly is a transformation play, and arguably the most fascinating case study in the industry right now.
For half a century, Southwest's identity was built on a very specific, highly successful model.
Open seating, bags fly free, and high-frequency point-to-point domestic routing.
It was egalitarian flying.
But the market has fundamentally changed.
That premiumization trend we spent so much time discussing left Southwest at a severe structural disadvantage.
Because business travelers and premium leisure travelers showed they were willing to pay for assigned seats and extra legroom.
Things Southwest simply didn't offer.
So now management is executing a monumental pivot.
They are moving away from open seating to assigned seating.
They are implementing bag fees to capture ancillary revenue.
And they are adding red-eye overnight flights to increase aircraft utilization.
If you've ever flown Southwest, you know the drill.
You set an alarm to check in exactly 24 hours prior.
You get your B group boarding pass.
And you line up at the polls, hoping to grab a window seat while judging everyone who saved a middle seat.
It's part of the brand's cultural fabric.
To abandon that for assigned seating isn't just an operational change.
No, it is tearing up a 50-year-old social contract with their most loyal flyers.
The execution risk there is astronomical.
But the market seems to be pricing in a lot of hope for this transformation.
The stock is currently trading in a wide, volatile range around $43 to $52.
Management has set a 2026 EPS target of at least $4.
The core investment thesis here revolves around the earnings step-up.
Analysts are banking on the idea that charging for assigned seating and bags will instantly inject hundreds of millions of dollars in high-margin ancillary revenues straight to the bottom line.
That is the bull thesis, yes.
The logic is that it costs them essentially nothing to charge you for a seat assignment.
So that revenue drops straight to net income.
But the execution risk you mentioned cannot be overstated.
Southwest's entire brand loyalty was built on being the anti-airline.
The friendly, transparent, no hidden fees carrier.
By adopting the legacy carrier fee model, they risk deeply alienating their core customer base.
If those core customers decide that Southwest is now just like every other airline, nickel and diming them.
They might start shopping purely on price.
Exactly. And that exposes Southwest directly to the ultra-low-cost carriers, like Spirit or Frontier.
Furthermore, from an operational risk standpoint, Southwest operates a single fleet type.
Flying exclusively the Boeing 737.
Amidst the ongoing supply chain disruptions and intense regulatory safety scrutiny surrounding Boeing,
Southwest is entirely captive to Boeing's delivery schedules.
if Boeing delays aircraft deliveries, Southwest's capacity growth stalls entirely.
When we look at the sector comparison, it is clear Southwest is the momentum play right now,
In early 2026, the stock was up 23% year to date.
which far outpaces Delta's flat, steady performance over the same short window.
But the valuation metrics are wild. Southwest is trading at an elevated PE ratio of around 64.7.
While Delta is sitting at 9.
That elevated 64.7 PE ratio is a classic hallmark of a company undergoing a structural transformation.
Their current earnings are artificially depressed because they are spending massive amounts of capital to implement this transition.
Reconfiguring cabins, updating booking software, marketing the new brand identity.
Because current earnings are low, the PE multiple looks astronomically high.
Investors buying at these levels are not paying for current earnings.
They are paying for what they believe earnings will be in 2027 once the assigned seating and bag fees are fully optimized.
However, we must note a critical macroeconomic vulnerability.
Southwest is highly exposed to the U.S. domestic market.
Unlike Delta and United, who can lean on booming, high-yield international travel.
Southwest is fighting for market share in a domestic segment that is currently shrinking under those exact stagflation pressures we outlined earlier.
Looking at their latest developments, they successfully navigated Winter Storm Fern in Q4.
That was a massive test of their operational resilience after their infamous holiday meltdown a few years ago.
And they passed.
They are expecting 66 Boeing 737-8 deliveries in 2026, assuming Boeing hits their targets.
And they returned significant value to shareholders with $2.6 billion in share repurchases in 2025.
So how do we predict the stock's movement over the next 8 months?
Expect extreme volatility.
The institutional market is currently holding its breath, waiting for the booking curve data.
The booking curve is how airlines and analysts track future revenue based on advanced ticket sales.
Once we start seeing tangible data on how many customers are actually paying the new fees for assigned seating,
And more importantly, whether overall booking volumes are dropping due to customer defection over the policy changes.
the stock will react violently.
If the booking curve data shows the transition is successful and the consumer accepts the new model without abandoning the brand.
Predictions point to the stock breaking past $60.
But if the data shows serious customer defection,
That inflated multiple will compress incredibly fast.
while Southwest is trying to completely rewire its cultural DNA to find profit, our final major carrier is simply trying to dig its way out from under a mountain of its own past financial decisions.
Let's look at American Airlines.
Ticker symbol AAL. We are calling this the debt-first narrative.
American generated a record $54.6 billion in revenue in 2025.
But their GAAP net income was a minuscule $111 million.
That equates to a razor-thin 0.2% margin.
That 0.2% margin perfectly illustrates why this is a debt-first narrative.
The anchor holding American Airlines back is their $36.5 billion in gross debt.
They are generating tens of billions in top-line revenue.
But a massive portion of their operating profit is immediately consumed by interest expense just to service that debt load.
Under the current Isom era, referring to CEO Robert Isom, management has completely pivoted away from flashy network expansions.
And is focusing entirely on operational reliability and cash generation solely to pay down that debt.
They paid down $2.1 billion in 2025, which is commendable.
But $36.5 billion is still a towering figure that restricts their strategic options.
Because of that immense debt load, the valuation is incredibly complex.
The stock is trading down in the $11 to $14 range.
The forward PE is extremely volatile depending on how analysts model their variable interest rate payments.
But the consensus target price averages around $17.62.
And Citi even rates them a buy with a $21 target.
I have to ask, why would a major institution like Citi Put a $21 target on an $11 stock that only has a 0.2% margin.
Because American Airlines is the ultimate deep value and high beta bet in the sector.
To understand a high beta stock, you have to look at the mechanics of enterprise value and leverage.
If a company has a massive amount of debt, its equity value, the stock price, is just the thin slice sitting on top of that debt.
If American can successfully improve their margins even slightly and use that cash to continue paying down the debt,
The enterprise value of the company might stay the same, but the equity slice grows exponentially as the debt slice shrinks.
it is a classic leveraged equity play.
If they avoid bankruptcy and steadily deleverage, the percentage upside from an $11 entry point is massive.
But the risks are equally massive,
They have fractured labor relations, the highest debt load among the major carriers.
and they simply do not have the margin buffer that a Delta has to absorb a sudden, unexpected spike in fuel prices or a macroeconomic shock.
Compared to rivals, American is often viewed as the bronze medal of the big three legacy carriers.
They lack Delta's premium margin efficiency, and they lack United's massive, high-yield international footprint.
But looking at the data, we cannot ignore their domestic scale.
They hold a superior domestic market share of 21%.
And they absolutely dominate mid-sized U.S. markets through their hub-and-spoke model.
That domestic dominance in mid-sized markets is their primary structural moat.
If you live in a mid-sized U.S. city, like a secondary market in the South or Midwest, American Airlines routing through Charlotte or Dallas-Fort Worth might be your only viable frequent option to connect to the broader global network.
But recently, they've been severely battered by external operational events.
The devastating impact of Winter Storm Fern caused over 9,000 flight cancellations for American.
It was the largest weather disruption in the company's history.
And based on the reports, it's expected to result in a $150 to $200 million revenue hit for the first quarter of 2026.
On the strategic side, they are rolling out new flagship suites to try and claw back some of that highly lucrative premium corporate travel from Delta and United.
So how do we model the predictions for American Airlines over the near term?
We are currently entering a crucial 90-day catalyst watch.
The institutional market is waiting to see the early yield returns on those new flagship suites.
Can American actually convince the premium high-paying traveler to choose them over the proven products at Delta or United?
The Q2 2026 earnings report will be the ultimate test.
Investors need to see tangible proof of margin expansion and proof that the free cash flow generation is sufficient to continue aggressively deleveraging the balance sheet.
If they stumble in Q2 or if a macro shock hits, the deep value thesis falls apart very quickly. Okay, that wraps up our in-depth analysis of the four major U.S. carriers. Before we conclude, let's briefly zoom out and catch two quick updates from the broader aviation ecosystem that tie directly into everything we've discussed today regarding capacity and demand.
First, looking at global airport infrastructure, Corporation America Airports, ticker CAA, reported that passenger traffic surged 8.8% in January 2026.
That CAP data point is a vital macro indicator.
It proves that despite the stagflation fears and cost of living anxieties we discussed in Part 1, the underlying global demand for travel remains incredibly robust at the physical infrastructure level.
People are still moving through terminals at record rates.
And on the supply side, looking at aircraft leasing, AerCap, ticker AER, saw its shares fall 3% after issuing weaker-than-expected 2026 guidance.
They projected $12 to $13 EPS, which missed the 14.76 analyst expectation, despite having a record year in 2025.
The AerCap situation perfectly reflects the broader supply chain constraints we've touched on.
Their 2025 record results were heavily padded by $819 million in gains from selling off assets.
Their lower 2026 guidance excludes those one-time asset sales.
It highlights how much the global aircraft leasing space is currently dictated by tight manufacturing supply chains and the strategic high-priced trading of existing aircraft assets, rather than just recurring leasing revenue.
Airlines are desperate for planes, and lessors are navigating a very constrained environment.
So, bringing all these threads together, we have unpacked the macro stagflation environment and AI productivity integration.
We've explored Delta's undisputed premium dominance, United's strategic international leverage, and cash conversion.
Southwest's monumental existential transformation, and Americans' high-stakes battle with debt.
Before we sign off, what is one final provocative takeaway for the listener to consider as they analyze this sector?
If we connect all the data we've reviewed to the long-term, bigger picture, there is a massive systemic variable we haven't fully priced into these valuations.
With the entire aviation industry pouring billions into sustainable aviation fuels, or SAF, to meet strict 2030 regulatory mandates, what happens to the valuations of these legacy carriers if the SAF supply chains simply fail to scale in time?
If production bottlenecks force airlines to rely on massive, punitive carbon offset penalties instead of actual sustainable fuel, could the cost of this mandatory green premium become the ultimate disruptor of airline profitability in the late 2020s?
It is a systemic regulatory risk that could turn today's record revenues into tomorrow's structural margin crisis.
That is a phenomenal question, and it is definitely something you should be actively tracking as you model out these specific stocks for the rest of the decade.
Remember, while we have done a comprehensive deep dive into the data, the financial reports, and the macroeconomic variables, investing always carries inherent risks.
And you must do your own extensive research before making any portfolio decisions. Thank you so much for joining us on this deep dive into the skies. We will see you next time.